In this week's video, we'll review the latest charts, data sets, and studies to help us answer the question, will overheating kill the bull market? If you've been following the markets closely in recent weeks, you know it's been all over the place. We've had big up days followed by big down days, followed by big up days. And that really shouldn't surprise any of us because we're in an environment where the topics of inflation, interest rates, and Fed policy are driving the markets. And those are volatile topics that we've been talking about in these videos for a long time, and we should expect those topics to drive the markets for years to come, which means we need to get accustomed to volatility. We've covered a different form of this chart in recent videos, but the concepts are the same. This is energy XLE relative to tech XLK. Chart goes back to late 2018. Let's start here in late 2020. Where the market starts to become a little bit more concerned or aware about inflation, interest rates, and Fed policy. When inflation is rising, commodity prices tend to have an upward bias, and thus earnings for energy companies, those type of earnings can be insulated, at least on a relative basis, compared to the market. You can raise energy prices. Conversely, a lot of tech companies, you're buying future earnings. And when interest rates are rising and you use discounted cash flows, earnings 10 years from now are worth less when you plug in a higher interest rate. Thus, it's not surprising when the market starts to get concerned about inflation, Fed policy, and interest rates, the XLE-XLK ratio tends to rise, as it did here in late 2020 into Q4 of 2021. So notice the slope of this line before the bear market starts in 2022, and then notice the slope of the ratio, how it shoots up rapidly as fear of inflation spikes. This is January 2022 here. Now compare and contrast the slope of this line in 2021, setting the table for the bear market in 2022, with the slope of this line here in 2023 and into early 2024. So the takeaway from this chart, how is it helpful to us? This is the type of look that we want to avoid. This is your bear market look. Again, look at the slope or the rapid rise of the ratio. Look at the magnitude of this move here where my cursor is in early 2022 relative to the magnitude of this move here when the S&P 500 was correcting in 2023. Thus far, the move that we have looks more corrective in nature. And since the markets are volatile in the short run and they've moved a long way, it wouldn't be shocking if the S&P 500 pulled back, tech pulled back a little bit more, and this white space from point A here to point B gets filled. It's the latter stages of the correction here into October of 2023. Not saying that's going to happen, but also look at the slope of this line starting to flatten out, the anchored volume weighted average price line tied to this high here. This is an area, these two lines, of potential resistance. Markets like to fill white space, so this really may be our bull-bear demarcation line. This is what it looks like when a correction ends, and here, this is what it looks like when a bear market starts. And nothing's etched in stone here. These are general concepts, and we would still be using a weight of the evidence approach, not a single chart or single ratio. We have numerous charts and numerous ratios and numerous data sets that we use to monitor the market's interpretation of these three topics down here: inflation, interest rates, and Fed policy. This ratio in this environment does a good job of illustrating those general concepts. So given what we know, chart dated April 11th, we still have more of a hesitation or corrective type look relative to a bear market look. Those odds would start to shift if the ratio can get out to this area here, and the longer it stays in this area here, the more concerning it would become. But the real battle lines most likely are between this light blue line here tied to this low. So notice last year when we corrected, we held above that line. Here we overshot it, but we're back above it. So these lines down here, and really this line up here from the bear market, with this being an intermediate term point of reference. If you're a stock market bull, you really don't want this ratio to get out here. So we're not making any assumptions about how this unfolds. We'll learn something either way. And you may be sitting on your couch watching this video and thinking to yourself, Chris, this is great. You're covering a chart dated April 11th, and the markets got drilled on April 12th, Friday. S&P 500 was down 76 points. And you also might think, given the numbers on your screen here, and given Friday, the commentary was that the market was concerned about inflation, you might think with the S&P down 76 points that XLE on Friday, April 12th, absolutely trounced XLK, meaning this chart here shot into this white space on Friday. That was not the case. On Friday, April 12th, full session, XLE slightly underperformed XLK. So all the commentary still legit. We'll take it day by day, no assumptions. Anchored volume weighted average price chart, S&P 500 daily, dated April 11th. Good example here. We have a big down day on Wednesday of this week, followed by a significant up day on Thursday. In the grand scheme of things, neither of those moves mean a whole lot relative to the primary trend. But there's no question the market has somewhat of a stalled or indecisive look up in this region here. 2024 starts here. It's always good to have reference points. They help you calm down. This is the anchored volume weighted average price line tied to the last trading day of 2023. That can be relevant. Wouldn't be abnormal for the S&P 500 to come back at some point and tag this line in a typical year. In a really strong trend year, it may not come back and tag it. But it's good to know where it is. It's at 50.10. That's approximately a 5% correction from the closing high down here on March 28th of 52.54. Two additional logical reference points. Anchored volume weighted average price line here tied to this high, the pre-corrective high in 2023 is the purple line here. The orange line is the anchored volume weighted average price line tied to the October 2023 low. The orange line is at 48.29 and the lower purple line is at 46.82. 5% is the first line. Approximately 8% correction would be the second line. Somewhere in the neighborhood of a 10 to 11% correction at this line here. And we'll revisit these concepts in a moment. But first, let's look at another way to monitor the question about a bear market versus a correction. Ultimately, all of this helps us monitor the market's appetite for risk. Here in late 2021, on this chart, we're looking at defensive staples XLP. Think toothpaste and toilet paper, things you need, things you're probably going to buy regardless of economic conditions, relative to tech XLK. Late in 2021, before the bear market starts, the S&P 500 doesn't peak until early January 2022 and here. And before that, this ratio has already started to move up for several weeks in here before the S&P 500 peaks. That's not what we have as of the close on April 11th. In early January 2022, this ratio is making multi-week new highs in here. We don't really have that, but we do have some consolidation and indecisiveness in here. So when fear is increasing, this ratio tends to move in this direction, from lower left to upper right. Conversely, when fear is decreasing, NASDAQ bottoms right here very, very late in 2022. When fear is decreasing, it tends to move from the upper left to the lower right. And we still have that type of trend in 2024. Compare and contrast the movement in the ratio here during the bear market, the early stages in here, Q1 2022, with what the ratio did during the correction in 2023. It was volatile, but it really never took on a trend flip look. This is a trend flip look here. Eventually, the ratio gets above the 250-day moving average. It flattens out and turns up in black right here. We don't have anything even remotely close to that when the market corrects in 2023 here. So compare and contrast the look of the ratio or price relative to the moving averages during the correction, the S&P 500 correction inside this blue box. This look is significantly different relative to this tight clustering trend flip look over here in the red box. Look at all the white space between the lines in the blue box, and look how close together the lines are in the red box. This is a coiled spring look over here. This is a strong downtrend look over here. We have something somewhat in between, but no question, this is at least 80% strong downtrend look, and the blue box here in 2024 really doesn't look anything like Q1 of 2022 at this point. So as always, we're not making any predictions about what happens next. This is the chart that we had in front of us as of the close on April 11th. And that's even within the context of all the wild volatility that we've had, big up days followed by big down days. In the short run, that trend may continue. Why? Because the market is once again concerned about inflation, interest rates, and Fed policy. And that tends to produce wild swings. So get used to it. And notice from a magnitude perspective, a 5% pullback, an 8% pullback, a 10 to 11% pullback, those fall into 100% normal and to be expected correction territory that occurs fairly frequently within the context of a bull market and/or uptrend. So let's look at a third chart using similar concepts to the charts that we just covered with the XLP-XLK ratio. This is XLP divided by SPY. It's a weekly chart with the 200-week moving average here. Bottoming process in 2016, when we really ramp up to risk on late in 2016, you can see the ratio drops below the 200-week and starts to fall. This is a risk on look. Similar situation down here after the COVID low. We drop below the 200-week moving average in red and the ratio falls. This is risk on. This is what the chart looks like on April 11th, 2024. We really don't have anything that looks like a trend change. So if this look here, the weekly trend, starts to morph into this increasing fear look here in Q4 of 2021, early 2022, where the S&P 500 is peaking and falling down here, then concerns would increase. It's also noteworthy, in Q1 of 2022, subtle, but look at the 200-week moving average. Starting to flatten out a little bit here in a concerning and bearish manner. Contrast that with the slope from January 1st of 2024 here to the present day here. If anything, the negative slope is increasing. The slope of this line here is different from this slope here. It's subtle, but relevant, just as this was subtle and turned out to be relevant. So the look of this chart here and the look of this chart here would tend to align with the concept that even if the market pulls back 5 to 10 to 12%, that there's a good chance that it would hold in one of these areas here. Again, not making any predictions. These are simply reference points, and they can be very, very helpful. The market held here in Q4 of 2023 at a very logical level. The intersection of the anchored volume weighted average price line tied to the 2022 high here, and the anchored volume weighted average price line tied to the October low here. Came right back to it, kissed it, and rallied. Thus, if price action gets back to this line, or this line, if, we'll learn something either way based on what happens. Keep in mind, markets like to overshoot in the short run. Very short stay below these two lines here in late October 2023. Now let's shift from this April 11th, 2024 chart of the S&P 500 over to the May 18th, 2023 version. Again, daily chart, anchored volume weighted average price line. Let's set the stage here, because these concepts that were helpful in this window here are relevant again in April of 2024 on different charts. We just talked about the anchored volume weighted average price line up here tied to the 2022 peak in early January 2022, and the anchored volume weighted average price line down here tied to the October low. What do these lines help us with? They help us with the average cost basis. When you're above the lines, the average market participant, based on their entry point, weighted by volume, is profitable and happy. When price is below the lines, the average market participant, based on their entry point, weighted by volume, is unhappy. They're at a loss. So this speaks to overhead selling pressure. This speaks to overhead selling pressure. What does that mean from a psychological perspective? When the market's down here, somebody is saying, if we get back to here, I'm selling. When the market's down here, some market participants are saying, if we get back to here and I get back to break even or I become slightly profitable, I'm getting out. Same thing happened here in early 2023. But why this chart was relevant in May of 2023 is this is subtly starting to look different. And we covered this in May of 2023 numerous times. Instead of being rejected, this is kind of a steeple look, fairly sharp rejection. You don't stay above the red line very long. It looks subtly different in May of 2023, and that turned out to be relevant. And as we just noted, down here, relative to all the color lines in your screen, the red, the light blue, the darker blue, and the orange, all of those market participants, the average market participant, based on their entry point, weighted by volume, was at a loss down here. Not true here. Based on their entry point, weighted by volume, is profitable and happy here. So as the market moves in this direction, there's really not a big reason for them to sell. They're making money. If they hold, they continue to make money. So you don't have a lot of overhead selling pressure, almost none in here relative to these lines. And these are the most relevant lines. We can't find a line that's above price. That's why you draw so many lines. You have to understand the context. Can I find a line that could act as potential resistance? When you're here in May, based on these time frames, the answer was no. And that was bullish. Turned out to be helpful. Same concepts up here when the NASDAQ starts to underperform in 2021. This is the look ahead, the early adopters that are becoming concerned about inflation, interest rates, and Fed policy. So this is your risk off look on those topics. It flips at exactly the point where the NASDAQ bottoms down here in late 2022. And this is we're less concerned about inflation, interest rates, and Fed policy. And much like this subtle little shift here that we talked about back in May of 2023, we have something similar on this chart. Notice the relatively short stays above the lines here, rejected. Look how short this stay is. This one's a little bit more relevant here relative to this one. And since then, in 2024, we've stayed above all of these lines for much longer than really anything that we have in this entire window back here, all the way to this peak. Now, this is still indecisive in here. If this ratio breaks into the white space up here and makes a higher high above these highs, that would be very similar to May 18th, 2023. We're exceeding this high here in this general window here in May of 2023. That was relevant. That was a higher high above all of these lines. Haven't done that yet, and we've got a tight cluster in here. So if price moves in this direction, that means concerns about these topics in terms of how they'll impact the economy and earnings would be lessening. It doesn't necessarily mean the market thinks inflation is under control. The market may believe that the economy and earnings can deal with it. Conversely, if this ratio gets into this area here, that would be concerning. That would tell you that these topics possibly could produce another bear market. Right now, this leans bullish, just as this chart did in May of 2023. Still hasn't made the higher high. We'll take it day by day with no assumptions. This one's a lot messier, but it's basically the same concepts. Everything that we covered on the last chart with the NASDAQ relative to the S&P 500, we have very similar concepts with growth stocks. Again, think future earnings and discounted cash flows relative to more boring and stodgy value stocks that tend to grow their earnings at a much lower rate, but they tend to be more stable in terms of their ability to produce those earnings. Here's the risk off here. Notice how the line plummets in January of 2022 in this area here. Right now, we just have an indecisive look over here, but within the context of a bullish breakout above the anchored volume weighted average price lines. And if you go back in time several years, all of these lines have been relevant and are relevant. And it's relevant that we've been able to climb back above all of them. Down here, we were below all of them in early 2023. The longer we stay above these lines down here, the more relevant it becomes. And notice the slope of the lines here are down, 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 down. Turning back up, turning back up, turning back up. All of these are still up. That means the long-term trend never flipped, going back years. This too still has a longer-term bullish bias and would tend to agree with this chart and the current look of this chart and the current look of this chart that say if we see weakness, the odds are it's most likely going to be more corrective in nature in terms of the magnitude, maybe 5 to 11%, rather than a full-blown bear market. All of that is subject to change. All of the commentary is based on the charts in front of us. We'll learn something either way. That's why we have to take it day by day with that flexible, unbiased, and open mind. In this environment and based on our time frame, a fair question would be, why are you even concerned about these shorter-term charts when we believe we're in a secular trend? Because we don't want to make an assumption in the present day that a market that looks like the blue box isn't going to or can't evolve into something that looks like the red box. Because as we discussed last week, years of progress can be wiped out in the red boxes. So from a shorter term perspective, if we zoom in on this chart here, this is SCHG growth divided by VTV value. Right now, this stagnation in growth relative to value since February 9th at the moment looks more like a normal corrective shorter term move within the context of an existing uptrend. This little window here looks more corrective in nature as this window did in here. But from a short-term perspective, if the ratio can stay above the colored anchored volume weighted average price lines, including the black one tied to this high here, that's a good sign. We'd learn something about bearish probabilities if we move into this area here. Keeping in mind we did that here, but it was a short stay. That's why we always say longer below, the more relevant it becomes. Right now, the last thing this ratio did was make a higher high in early February, and that's exactly the same window here where Tech XLK started to stagnate. It's really made no progress either way since early February. So we'll look at a chart like this in the coming days and weeks and see what we can learn. Right now, this chart would vote more toward the more upside or a normal correction end of the spectrum relative to the full-blown bear market end of the spectrum. Back to the May 18th, 2023 concepts. This consolidation here in May of 2023 above the anchored volume weighted average price lines tied to a major high and a major low and the COVID high and COVID low here, all of that was relevant. Fast forward to April 11th, 2024, and we have a similar and constructive look for small caps. A lot of times you'll hear, why so many lines? They're relevant. These tight clustering looks here, drawing multiple lines, tell us this is a very important battle zone here. This represents strong potential support, with the key being on the term potential. If it breaks, then you learn something. That wouldn't be good. So this is 2024 right here for reference purposes. For the most part, we've spent the entire calendar year above this band here. That's very, very similar to this subtle shift here in May of 2023. And the market from this point here rallied for somewhere in the neighborhood of an additional 10 weeks before it corrected. The correction started in early August of 2023. So in isolation, this laggard, small caps, is also leaning more bullish long-term leans more towards a normal correction if we pull back rather than this full-blown bear market look in here. This is bullish long-term for small caps in isolation at the moment. But if we look at a similar chart relative to the S&P 500, we don't have anything in hand here that tells us small caps are about to flip to a leadership position. This chart over here helps you with weightings. Do I want to own it? Chart on the right leans yes. Do I want to own a ton of it? Chart on the left leans no. On a relative basis, you probably don't want to own a ton of it at this point. If it takes on more of a counter trend move like this, then your shorter term weightings could increase. But this too, as we know, was a counter trend move within the context of a long-term downtrend against small caps relative to the S&P 500. If you want to look at more traditional charts, it's still in a downtrend, well below the downward sloping 250-day in black here. We also know about this topic over here in interest rates. You can pause your video player. It still applies. Longer term context, still secular trend bias to the upside. Intermediate term, have somewhat of a stalled look here. We had a stalled look earlier in January of 2024, and that resolved to the upside. It's possible that happens here. It's also possible we have some type of corrective process coming day by day. We want to make sure that concerns about corrections don't overwhelm us and cause us to overtrade. This is the primary goal over here on the right side of the screen. This is also relevant because we don't want to assume that a correction can't morph into a 50% drawdown. So where do we stand on the secular trend topic? Do we currently look more like a blue box? We currently look more like an orange box? Or are we starting to look like the dreaded red box? Updated the model after the CPI report, after the close on April 10th. Unequivocally, based on the data that we have in front of us, we look like one of these blue boxes. We don't look a lot like an orange box, and we really don't look anything like the red box over here. And you may have heard us say in recent weeks that the secular volatility model can't tell us what's going to happen tomorrow. It can't predict the future. And you might have said to yourself, well, what good is it? That somewhat misses the whole point of monitoring markets, using data and using technical analysis. Quote from George Soros, who has made tons of money in the markets. The sad part is that as much money and brain hours that go into predicting the market, it is a completely unnecessary activity in achieving success in the market. Let's repeat that. Predicting is a completely unnecessary activity in achieving success in the market. Another key point, tape it to your computer screen. Trading is about probability and risk management, not about predictions. That's why this is useful. We don't need to predict the future. We need to understand what the present looks like and understand what that tells us about probabilities related to future outcomes, good and bad, and what does that mean relative to how much risk we're willing to take. This is a good example of it. Here's the headline from Wednesday after CPI. Dow closes 400 points lower. It's very, very easy to overreact. The data over here, calculated after the close and can be calculated during the session, says just try to relax at this point. At this point, it's a normal volatility within the context of a blue box. And it's possible that the blue box could morph into an orange box. But the data doesn't support that at this point. And keep in mind, blue boxes can have pullbacks. Normal pullbacks. Doesn't necessarily mean if you drop 5% that you're out of the blue box. It's also relevant that this, and this fit in with the typical drawdowns that you see within the context of secular trends, 1956 to 1968. Can make an argument we're in a similar window now. Median drawdown, 10%. Guess what happened after that 10% drawdown? The market went on to make higher highs. If you didn't overreact, your portfolio went on to make higher highs in terms of the balance. Another secular trend window that's similar to the present day. 1989 to the end of 1999. Median drawdown in that window, roughly 10%. If we look at all 20 cases in the two windows, drawdowns greater than 6%, Median drawdown, roughly 10%. Average drawdown, 12%. So if we're trying to navigate between a point A and a point B that could be several years down the road, with the benefit of hindsight here, if you did nothing in this window here, your balance was higher here. If you did nothing in here, your balance was higher here. If you did nothing in here, your balance was higher here. Hence, in these type of windows, we're in mitigation 1. Why mitigation 1? Why not just do nothing? Because we don't want to make an assumption that we can't morph into the red box. Red boxes can wipe out years of progress, and they basically can cut your portfolio in half, something that we're not interested in due to these bullet points up here. We should also keep in mind a 5 to 10 to 12% pullback, normal in these windows. They're also very normal in general in markets. Typical year, S&P 500 sees 7 cases where you dip in the neighborhood of 3%. Don't want to overreact. More than 3 cases where the market pulls back approximately 5%. 10% correction happens typically once a year. In a bear market, every 3.5 years. It's a tech sector as of Thursday's close. This is the correction last year. Notice all of this price action occurs above an upward sloping 250-day here in black. Price comes back in this case and tags an upward sloping 175-day here. Got a lot of room in here to correct where we could have something similar like this, and all of it would occur within the context of a clearly upward sloping 250-day moving average. And in this case, if you were patient and didn't overreact, XLK printed a higher high here and has been profitable relative to this correction here. So our work is ongoing to help us with all of this, and helping us assess probabilities to avoid, hopefully, something in the future like this. Also noteworthy that the current base case aligns with these concepts here. You can pause your video player. The S&P 500 hasn't had a 2% down day since February 21st, 2023. This is the 12th longest such streak since 1928. Common sense tells you that that's most likely bullish, because the net aggregate opinion of all market participants regarding all subjects on all time frames has been very favorable. You can read this and the data backs that up. After similar moves, average gain 12 months later in the S&P 500 over 10%, median gain in the S&P 500 over 10%. Similar concepts here. VIX was extremely low. It picks up a little bit, meaning volatility picks up as it has in recent sessions. Not necessarily bearish. Average gain 12 months later, 10.4%. Median gain S&P 500, 12.5%. This and all of this and this aligns with the numbers here on your screen. A lot of long hours in this window, but they've been fruitful. We're making progress. Still on track relative to these bullet points. We're slowly but surely picking off additional years. Still have work to do. We haven't seen anything yet to contradict anything that we believed heading into this, and we're learning a lot. As we wrap things up for the week, some other noteworthy items. Somewhat surprisingly, big red day on Wednesday the 10th. That was the day that CPI came in hot. Growth outperformed value. Same thing on Thursday, April 11th. Also surprising, the big down day on Friday, April 12th. Same concepts. Growth outperformed value, or in this case, value underperformed growth slightly. So this is the look of the value versus growth chart as of the close on April 12th. You can see this period over here in early 2022 looks significantly different from 2024. Let's call this an anecdotal study. Notice this on Friday. This is a recycled weekly DeMark sequential count in Q1 of this year. This R right here. Anecdotally, because I may have missed some cases. Doesn't occur very often. It occurred here. See the R right there? 2003, and it occurred here in 1995. Without going into all the details, a recycled count basically reflects an extremely strong and bullish trend. Thus, it's not surprising when we saw a recycle count here and a recycle count here from a long-term perspective. Really good things happened. Case within the context of the secular trend long-term, the S&P 500 gained an additional 216% over the next 1,858 calendar days. 2003 case, during a period of secular stagnation, so thus it's not surprising, the gains were relatively muted but still excellent. There was volatility in this case because interest rates were involved. In fact, we came back and for the most part undercut this level, but longer term, the S&P 500 tacked on an additional 43% over the next 1,387 days. Both of these are from the end of the week when we saw the recycled count. We saw the recycled count in January of this year, simply telling us to keep an open mind about better than expected long-term outcomes. The Mark Daily chart over here, this is an area of potential support, the red diamond, 5013. That coincides with this area of gaps here on the daily chart of the S&P 500. As a reference point, this is 5013. We closed at 5123. And we all know, if we're going to effectively answer this question on the right side of the screen in the coming weeks, it's important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.